Welcome to vTalkInsight, Market Drivers Daily for January 16th, 2026. Markets are digesting a powerful mix of resilient growth data, a sudden reversal in oil risk premia, and a renewed surge in AI optimism off the back of TSMC's guidance. Let's unpack how those forces are reshaping risk sentiment across assets today. The growth backdrop remains more resilient than many had positioned for. Fresh U.S. data and corporate signals point to an economy still expanding at a solid clip, while the equity rally shows early signs of broadening beyond the mega-cap tech leaders that dominated last year. This combination of firm activity and shifting leadership is becoming a central driver of cross-asset performance. On the macro side, U.S. labor market prints continue to surprise on the strong side. Initial jobless claims have dropped to around 198,000, with continuing claims also easing, indicating layoffs remain limited and hiring still healthy. Regional manufacturing surveys from both the Philadelphia Fed and New York show notable improvement, even though employment components lag a bit. Together, that supports a picture of ongoing consumer-driven growth, rather than an economy flirting with recession. Corporate earnings signals are consistent with that strength. Morgan Stanley has reported a roughly 47% year-on-year jump in investment banking revenue, driven by a rebound in mergers and acquisitions activity. Looking ahead, deal makers expect investment banking to accelerate further into 2026 and 2027, helped by tight credit spreads and constructive market conditions. That kind of pipeline tends to reinforce confidence in capital spending plans and hiring, which in turn supports the broader growth narrative. Equity leadership is also quietly shifting. Strong November U.S. retail sales and an improving macro outlook have coincided with the Russell 2000 outpacing the S&P this year, and some expect a continued rotation toward small caps, industrials, metals, mining, and utilities in 2026. Market commentary highlights expectations for tax cuts, rebates, lower oil prices, and a deliberate run the economy hot policy mix as potential supports for cyclical earnings. That helps explain why a mild pro-risk stance is still favored in the near term, with robust profit momentum and ample liquidity offsetting concerns about valuations. Outside the U.S., the growth story is gradually improving as well. Germany has eked out a return to growth after 2 years of contraction, helped by stronger household and government spending and significant planned fiscal outlays on defense and infrastructure, even if investment and trade remain soft. The UK has delivered an upside surprise in November activity, and its innovation economy expanded by about 35% last year, outpacing global peers, with AI-related investments accounting for a third of inflows. European small caps, particularly in Germany's MDAX, are starting to reflect that tentative shift after a decade of underperformance. High-end consumption is reinforcing the picture of affluent-led growth. Strong recent sales at Richemont, driven by Cartier, point to a rebound in luxury demand across the U.S., the Middle East, and a stabilizing China. Luxury auction sales in jewelry, watches, and vintage cars are up by double digits, with younger buyers spending more in their second year and expanding into new categories. Non-U.S. equities have already outperformed U.S. stocks by more than 30% in 2025, supported by this backdrop and a weaker dollar. However, some houses now expect a firmer dollar ahead, with euro-dollar potentially around 1.13 by year-end, if U.S. growth stays strong and Fed rate cuts remain limited, which could temper enthusiasm for unhedged international exposure. There are clear caveats. Much of today's growth is powered by affluent consumption, AI-related investment, and asset price gains, all of which are less sensitive to interest rates than traditional credit channels. Front-end yields have been drifting higher as markets dial back expectations for rapid Fed easing, and questions linger about how durable Germany's recovery and European small-cap momentum will be. Key watch points now include weekly jobless claims, upcoming retail sales and manufacturing data, the depth of the small-cap and cyclical rotation, and progress on tax, deregulation, and fiscal packages. All of this is unfolding against a volatile geopolitical backdrop, where today saw an important shift in the energy risk premium. Earlier this week, we were talking about oil's strongest multi-day rally in over 6 months on fears of Iranian supply disruption. Today, that story has flipped, at least for now. Crude prices have dropped more than 3 to 4% after signals that the U.S. may delay military action against Iran and is adopting a softer near-term tone. Traders are unwinding a chunk of the geopolitical risk premium, and that is spilling over into lower prices for precious metals as well, as tariff threats on critical minerals are pushed back. Under the surface, however, Iran remains a major source of uncertainty. The regime faces intense internal and external pressure, with estimates of inflation near 50% and food price rises around 70%, reportedly eroding living standards. Brent crude near $60 is far below the fiscal break-even some analysts assign to Iran, creating a structurally fragile backdrop. Western sanctions, currency depreciation, and drought have all pushed the country toward costly imports, deepening social unrest. Yet heavily invested security forces still provide the regime with considerable staying power, meaning instability risks and the potential for sudden escalation remain firmly on the table. The oil supply map is further complicated by shadow fleets and Venezuela. The U.S. has shifted from simply sanctioning Russian, Venezuelan, and Iranian dark oil fleets to actively disrupting their operations, and Ukraine is now targeting Russia's Black Sea shadow fleet with drone strikes. So far, other supply dynamics have dominated, and there has not been a clear impact on global oil benchmarks. In Venezuela, U.S. majors are exploring opportunities, but memories of past nationalizations and political instability keep capital cautious. Shale producers also currently see limited risk that Venezuelan crude will undercut U.S. production in the near term. Beyond the Middle East, the Arctic is emerging as another geopolitical hotspot. Tensions over Greenland have intensified as the U.S., Denmark, and European allies vie for influence. The deployment of German, French, UK, Norwegian, and Swedish troops signals heightened NATO focus on Arctic security and raises the region's strategic profile. A new working group has cooled the immediate risk of unilateral U.S. moves, but fundamental disagreements remain unresolved. European officials warn that disputes over Greenland could delay ratification of a U.S.-EU trade deal, introducing a fresh risk for trade-sensitive sectors even as U.S. officials emphasize continued commitment to NATO and highlight rising European defense spending. At the same time, U.S.-China rivalry continues to reshape trade and supply chains. Washington has introduced a 25% tariff on certain advanced semiconductors, including high-end NVIDIA chips, while Beijing pushes for semiconductor self-sufficiency and tightens approvals for advanced imports. Policymakers are also zeroing in on critical minerals. A bipartisan proposal to build a strategic reserve and a choice to seek supply through partnerships rather than new tariffs illustrate a more nuanced resource security strategy. Frozen Russian sovereign assets in Europe remain untouched, serving as leverage in negotiations, and a major U.S. financial institution plans to deploy at least $1.5 trillion over the next decade into supply chain and national security-related sectors, reinforcing this structural capital shift. For markets, the message is that headline risk is easing in the very short term, but remains elevated structurally. Oil and precious metals risk premia have compressed as Iran tensions temporarily de-escalate, and container shipping rates inflated by Red Sea disruptions could reverse if routes normalize. Yet unresolved issues around Iran's internal stability, the overextension of U.S. military commitments, Greenland and Arctic governance, and the Russia-Ukraine conflict all leave scope for renewed volatility. Safe haven assets such as gold and silver remain well supported despite being seen as stretched, and geopolitical instability involving Russia, China, and the Middle East is still flagged as a key threat to risk assets. Watch oil price behavior, freight and insurance costs in key shipping lanes, progress on U.S.-EU trade negotiations and any expansion of sanctions or tariffs in technology and critical minerals. All of these intersect directly with the next major driver, the AI and semiconductor boom. Artificial intelligence remains the single most powerful unifying theme across growth and geopolitics, and TSMC is at the center of it. The company has delivered stronger than expected profits, guided to revenue growth near 30%, and laid out capital expenditure of roughly $52 to $56 billion for the year, around 15 to 20% above prior consensus. That guidance underpins expectations that AI-driven semiconductor demand will stay robust for several years, and it has reignited optimism across the technology complex, lifting U.S. equity futures and pushing chip equipment names such as ASML and Applied Materials to record or near record highs. TSMC's outlook suggests a multi-year infrastructure build-out rather than a one-off spike. The firm expects sales to AI customers to more than double by 2026 and then grow around 30% annually through 2029, and reports indicate capacity is effectively sold out through 2026. The broader semiconductor industry is projected to surpass $1 trillion in sales this year, a near 29% increase, with double-digit expansion expected through 2027. TSMC is planning at least 4 to 5 new fabrication plants in the U.S., helped by a trade agreement that could unlock about $250 billion of direct Taiwanese investment and an equivalent credit line, while ASML, as the dominant lithography supplier, is seen as a primary beneficiary. This Capex wave is rippling through the AI ecosystem. NVIDIA is viewed as a differentiated platform leader, reportedly sold out of AI chips through 2026 and already taking orders for 2027, while Broadcom's custom AI business is expected to grow roughly 150% in 2026 and 60% in 2027 off a diversified partner base. Investors are also highlighting semiconductor and chip companies linked to AI, 5G, and electric vehicles for their high margin potential. Beyond chips, crypto and data center infrastructure names, such as Galaxy Digital, are securing hundreds of megawatts of new computing demand, and utilities that power AI data centers, particularly in the U.S. Midwest, are attracting attention for their steady fundamentals. Within equities, AI is changing the shape of the rally. Earlier in the week, we noted investors starting to rotate away from the most crowded mega-cap AI exposures. Recent performance now shows a tilt toward hardware-focused AI plays, smaller cap names, and regional suppliers, with the Russell 2000 and European chip equipment stocks outperforming the broader indices. Earnings estimates across both large AI platforms and the wider market are being revised higher, an unusually broad upgrade cycle. Technology companies are projected to deliver mid-20% earnings growth, far above the low single-digit pace expected for the rest of the market, reinforcing the perception that AI remains a key profit engine. On the real economy side, AI adoption is moving from hype to implementation. Enterprise spending in 2025 is seen as a pilot phase, with 2026 and 2027 the real tests of how sticky AI software contracts are and how far productivity gains can stretch. OpenAI is reporting record high user engagement, with ChatGPT daily and weekly actives at new peaks and its Codex coding tool seeing about a 25% week-on-week jump in usage. AI is expected to target a knowledge work market worth around $2 trillion, with the potential to exert downward pressure on wage inflation as automation spreads. That underpins forecasts of AI-driven structural disinflation starting next year, improving corporate margins even as growth stays solid. Still, the AI story is not a straight line up. TSMC itself has flagged the risk of overcapacity if AI demand fails to match today's aggressive investment, and some see scope for a semiconductor supply glut by 2027. China's drive for chip self-sufficiency and U.S. export controls, including tariffs on advanced NVIDIA products, add another layer of policy risk. There is also growing concern about concentration risk around key platforms, such as OpenAI, even though revenues across leading AI firms have quadrupled over the past year. High-risk, high-reward AI data center and quantum computing names are attracting speculative interest, while AI-driven labor disruption is now visible in earnings from sectors as varied as banking, construction, and utilities. Markets will be watching upcoming AI earnings, hyperscaler Capex guidance, enterprise renewal rates, and any sign that today's capacity plans are overshooting demand. Those signals will go a long way in determining whether AI remains a stabilizing growth engine or becomes the next source of volatility. Pulling it together, today's tape reflects three intersecting forces: a surprisingly resilient growth backdrop that is broadening beyond mega-cap tech, a temporary easing of oil and commodity risk premia as Iran headlines to escalate, and an AI investment cycle that continues to power earnings upgrades while also amplifying dispersion and policy risk. Watching how small caps and cyclicals perform against large cap tech, how quickly energy and freight risk premia can rebuild on new geopolitical shocks, and how AI Capex plans evolve relative to real-world demand will be critical for navigating the months ahead. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.